Okay, so today we will focus on chapter 5, which is about budgeting and variances analyze. This is going to be our final chapter of element of costing, and this chapter, it is not going to be that much difficult, only is involving a very simple calculation. Okay, so budgeting is really important for accountant student, and it is one of the important uh, estimation for the future and what is your planning is going to be in the future as a company or as a business, or even sometimes you need a budgeting for individual, especially when you are a student and you have to managing and controlling your expenses and your income. So you have to think about that way. So always every household, they need a budgeting, company they need a budgeting, student they need a budgeting, and they need to controlling and stick with the planning. You have to stick with a planning. So uh, the outcome of this chapter, and hopefully by completing this chapter you are able to calculate variances and from the budgeting and actual data, then determine whether excuse me, the variances is favorable or adverse. Then I will explain it what is favorable and what is adverse. And then we look at the variances when we calculate variances, whether it is favorable or adverse. Then we look at whether it is significant or not significant, the variances between budget and actual. Okay, so we're looking at the calculating budget and actual. Then we're looking at the differences, whether it is favorable or adverse. Then we're looking at the level of the differences between the budget and actual, whether it is significant or not significant. Okay, so this is our three important point for today. Okay, so if we're looking at the overview of the chapter, it is going to be favorable or adverse. So, okay, for example, says you have a budget of £100 and you're going for a shopping. You would like to buy 4 pieces of clothes, and if you manage to buy it within the £100, so it is in favor of you. Or if you buy the 4 pieces of clothes that you are planning to buy within £90, it is much better. You're saving £10. It is in favor of you. However, if that 4 pieces of clothes costing you £110, more than £100, so it is going to be adverse. Okay, favorable, it means you are able to buy it with the budget which you're planning. Adverse, it means it is costing you more. Okay, this is the differences between adverse and favorable. So I already uploaded number of questions, then we'll look at the questions later on. Significant or not, for example, it says if you're planning to buying 4 pieces of clothes, says within £110, probably is only you spend £10, so the £10 is probably is about 1% or 2% extra more than your budget, it would be fine. But if it is costing you £130, says the variances between your budget and your actual, it is says more than 4% or 5%, then it is going to be significant. So you have a ratio where if it is excess of the ratio, then it is going to be a significant. If it is less than the percentage which you're expecting to be, it is not going to be significant. Again, we're looking at that in a practical question. Okay, then we're looking at calculating the variances, because if you remember, we have a budget and we have an actual, then we're looking at the differences between these two. And so if it is what the differences between the actual and budget is going to be your variances. So this is what we are trying to cover for today. Okay, so that's what I am trying to cover for today. Okay, so just give me 1 second. Okay. So what is the variances? Okay, what is the variances? Obviously, the variances is the differences between the income or cost between the actual and budgeted. So if you budgeted for an amount of money, so you have to think about it whether it is going to be controlled with that amount of budget. Okay, so this is what we are thinking of today. Okay, so we're looking at the income and the cost. Okay, so if your income is £100, okay, and the cost is £90, the variances is £10. This is this is a different. So in this situation, it is going to be favorable or adverse. So in this situation, it is favorable. Why it is favorable? Because obviously your income greater than the cost. Your income is greater than cost. Are you able to see my writing? Hi.
No, I can't see your writing.
Oh, you cannot see a writing. Oh.
It's okay that I'm following along.
Okay, I thought you are able to see my writing. I am writing on that, but you cannot see it. Okay, never mind. I don't know why. Okay. Okay, so this is the variances. Obviously, it is between the actual and budgeted, between actual and budgeted. So favorable, always we have a two type of favorable for income and favorable for cost. So we're looking at budget and actual. Okay, says your budget for costing is £100 and actual is £90. So you have £100 to spend, but in reality only you spent £90. Okay, so it is the variances is £10 between the budget and actual, and obviously it means you are saving £10. It is in a favor. It is a favorable. However, in terms of income, it is going to be opposite. Income and cost, it is going to be opposite. Always for the income, you're trying to your income, your budget of the income is going to be less than actual. So if, say, for example, your sales target is £100,000 for a quarter, this is your budget. This is your your budgeting. This is what you're planning to target. Your target is £100,000 sales for 3 months, and actually that 3 months you made 125,000. So it means you beating your expectation. So your actual is greater than your expectation. So it is again a favorable. It is a favorable. Okay, so income and expenses obviously is working differently. So if are you able to see this example? Example number 1?
Yes.
Great. Okay, so let's focus on this example. It says calculate the variances for sales and for each element of cost, and then identify whether it is adverse or favorable by placing an A or F. A standard for adverse, F standard for favorable in the last column, So element, we have a sales. Sale is income. Then we have a material, labor, overhead, admin, overhead. These are all expenses. So this budgeting is part of management accountant. Responsibility. If you remember, we say financial accountant and management accountant. So budgeting is responsibility of management accountant to prepare. And they usually preparing a budgeting planning on a monthly basis, on a quarter basis, and on annually, so annual basis. So they can have a three type of budgeting. Okay. So for sale, in terms of sales, so they have they estimated, they budgeted for sale. They says if we achieving our sales figure for £165,000, then it would be great. So and for the month, at the end of the period, the sales figure was 157,000. Okay, so you can see actually they did not meet the budget. They did not meet their expectations. Okay, they did not meeting their expectations. So they was expecting 165, but actual is 157. So obviously the differences between these two figures is 7,500. So variances, do not be confused which one is minus which one. Okay, variances, you do not have to be confused which one is minus which one. Always the greater is minus the smaller one. So the greater one is 165 and the less one is 157. So it means budget minus actual. So you look at the variances. So the variances between the budget and actual is 7,500. Okay, so this 7,500, does actual greater than budget? No. If it is no, it means it is actually adverse. It is not in our favor. This is sale because we were targeting, we were planning to sell 165,000, but the actual figure is 157,000. Okay, so it is adverse. It is not in our favor. It is not in the favor of the company. Okay. However, in terms of expenses, so the expenses are actually direct material, direct labor, production overhead, and administration overhead. So these are all expenses. So always you try your budget less than actual, opposite to sale. You try to be, your budget actually is your actual is less than a budget. For example, for direct material, you had a planning to be £20,000. So you allocating £20,000 for material. So, but the actual, in the reality, only it cost you £18,000. So 18,000 pounds. So it means the differences between these two figures is 2,000 pounds. The differences between these these two figures is 2,000 pounds. So again, the question is, does it is favorable or variances? The answer is favorable. Why it is favorable? Because it means we spent less than what we planned. We spent 2,000 less what we planned. It is a favorable. It is favorable. So again, for direct labor, we apply same thing. We budgeted 80,000, but actual is 82,000. It means costing us extra 2,000, extra 2,000. Excuse me. So it means we spent 2,000 extra. It is adverse. So I remember once I went for a job interview and they give me an example like this one. They give me example like this one, and they say, for example, labor in here is obviously you spending 2,000 extra. Why? What do you think? What is the reason? What is causing to spending 2,000 pound extra compared to what you budgeted? Well, in this situation, the reason maybe they spend 2,000 extra for labor, probably some staff, for example, you have a number of staff, for example, one of your staff, it went, had a baby, it went to the maternity. So when is one of your staff is having a maternity, on the maternity leave, so it means still you have to pay that staff which is on the maternity, and you have to employ somebody to cover her task, her duty. So that's maybe one of the reason the labor cost of labor increase. Another reason, maybe some of your staff, it is they are absent due to illness. So again, this is another reason for illness, maybe causing the cost of direct labor is go up. Okay, direct labor is go up because of the absent due to the illness. So that's two reason. Okay, two reason, maybe that's the reason your direct labor, it is the actual is greater than budget by 2,000 pounds due to the maternity, due to the absence of illness. Okay. Then the last one, production overhead. Okay, production overhead. This is a significant differences between a budget and actual. It is a significant production overhead. So again, it is a favorable, and usually the variances, it should not be that greater, because this is a concern. Even it is a favorable, but why there is a 35,000? Usually the variances is 2,000, 3,000, 5,000, 8,000, not that 35,000. So again, this is, it need to be addressed. Even it is a favorable, you need to be addressed. Again, the admin overhead, you can see the differences between budget and actual, 200 pounds. So we spent 200 pounds extra compared to what we budgeted. So it means again it is adverse. It is adverse. Okay, it is adverse. Any question regarding example number 1? Any question regarding example number 1?
No.
Okay. Okay, great. So we can move.
No.
Okay. Okay, so let's move to this time evaluating the significance of variances. So we already calculated the variances. The variances, it means, is the differences between your budget and actual. Variances, it is the big differences between a budget and actual. Adverse or favorable, it is depending on whether it is income or expenses or cost. Income or cost. If it is income, so you expecting your actual greater than budget, then it is going to be a favorable. If it is actual, it is less than your budget, then it is going to be adverse, like this one. For cost, always you're trying, if it is expenses or cost, you're trying to, your actual is going to be less than budget, then it is going to be your favorable, like this one. However, if it is your actual is greater than a budgeted, it is going to be adverse. It is not in your favor. It is not in your favor, like that one. Okay, so now we're going to evaluate, analyzing the variances. So now we're going to evaluating the variances in that column. Okay, so analyzing and evaluating. So what is, it says management do not want to waste time investigating small variances. Okay, so in here, what is the smallest amount? The smallest amount is admin overhead. It is only £200, so it doesn't worth it to actually investigate it. What you need to investigate, you need to investigating, for example, even the production overhead, why it is in first place they budgeted 65,000. You need to investigating that figure. Again, you need to investigating your sales. You need to investigating your sales. It is the difference is 7,500. It is, this figure is it is not very significant, but again you need to investigate it. You need to be investigated, especially if it is relating to the income. Always try your income, actually it is become a favorable rather than adverse. Okay, because it is income. So it says management do not want to wasting time investigating small variances such as the above one. For admin it is only £200. We don't have to wasting our time. So so deciding to investigating, so if the variance is greater than £500, if it is variance is greater than £500, so only investigate variances greater than 5%, greater than 5% of budget. So how do we know it is the variances is greater than budget by 5%? So simply variances divided by a budget times 100, then you will get it as a percentage. Then we will get it as a percentage. So if you dividing 7,500 by 165, so you can see it's almost about 5%. The differences, it is closer to 5%. Okay, so it is closer to 5%. So in this situation, it is 4.5% for sales. The variances between actual and budget is 4.5%. So in this situation, it may worth it to investigate. It may be worth it to investigate. Excuse me. Okay. So this is what it. So if we're looking at this example, if we're looking at example number 2, if we're looking at example number 2, okay, it says the following is a performance report for November, for month of November, for 1 month. Okay, remember what I say is budgeting prepared on monthly basis, on quarter basis, and on annual basis. Okay, so Usually you have a budget on monthly basis. So this budget is for 1 month, for month of November, and they say the variance is in excess of 10%. If your variance is greater than 10% of a budget, greater than 10% of the budget is deemed to be significant. It means it need to be a concern. Actually, it is concerning for a management level. For your line manager, it is going to be concerned if it is greater than 10%. Okay. So, and should be reported to management, So it's calculating the variances for sales and cost in the table below. Then examine the variances and indicate whether they are significant or not significant by putting S or S for significant or N is not significant into the last column, in here. So obviously we have a sales. Okay. So the sales figure, we can see the sale for, we budgeted 126,000, but the actual 145,000, and the difference is quite big. It is 19,000, almost 20,000. Okay. So in this situation, it says if it is greater than 10%, it is significant. So we can see it is obviously 19,000 divided by a budget. It is going to be more than 10%, and it is significant. So 19,200 divided by 126,500. Okay. So it is going to be 15%. The difference is the variance is 15%, and it is significant because it is greater than 10%. Again, for direct material, the difference is only £200. Okay, the difference is only £200, and it is not significant because it is not greater than 10%, because 200 divided by 22,000 is going to be a very small figure, percentage. For labor, again, labor is only £1,000. It is not significant. Production overhead, you can see the differences. The differences is 30,000. For sure, this is significant. Almost closer to 50%. The variance is closer to 50%. Okay, closer to 50%, 48 and something percentage. If we're looking at the admin overhead, you can see your admin overhead is very significant. It is a significant because the variance is between budget and actual is about 3,000, and 3,000 divided by 2,000, well, it is more than 100%. It is very significant. It's more than 100%. Okay, the variance is more than 100%. Okay. This is the exam question is similar to this, similar to example number 1 and example number 2. The exam question is similar to example number 1 and example number 2. Okay, example number 2. So this is the working of example number 2, what they did. Remember what I say is the variances divided by a budget. Okay, variances divided by budget. And 30,000 divided by 64, 46, and 3,000 divided by 2,400 is. So this is the formula, remember. This is the formula, remember, to calculating percentage of variances, you must dividing variances by budgeting, dividing variances of a budget. Okay, then you will get a percentage of the differences, whether it is significant or not significant. Okay, excuse me. And one more thing is about reporting the variances, because if you look at this example number 2, you have a sale. Remember, in organization, you have a sales manager, you have a purchase manager, you have a labor manager, and you have a admin and HR manager, and also you have a production line manager. So you have a different people responsible for different tasks, and you need to reporting each of these to a propriety manager. You have to report it back to a propriety manager. If it is labor, it is you have to the production line manager. If it's material, to production line manager. If it's sales, report it back to sales manager. If it is admin, you have to report it back to the HR. You have to report it back to the HR manager. Okay, so this is what reporting variances is about. So sales variances, you have to report it to sales manager. Material, purchasing manager. Material usage, again, production manager. Material usage for production manager. Okay, and labor, production manager again. Okay. For example, if it is material price variances, if it due to the price, maybe the price of the material is go up. So this is maybe one of the reason you have to speak to the purchasing manager. You have to find alternative supplier. You have to find alternative supplier. Okay. For if it is you're relating to the material, you have to think about usage of the material. Probably you have to using less material in the product. If it is labor, due to the efficiency, maybe it is number of staff it went to absent due to the illness. Okay, so these are again you have to thinking about the efficiency if it's relating to the labor. Okay, so again remember you have to report it to a propriety manager, line manager for each variances. That's all for today for this chapter. It is not that difficult. It is not that difficult. So what we're going to do, so we're going through the questions. Excuse me. So first of all, I am coming out from the screen. Stop sharing. Okay, so okay, so let's go to your Google Classroom. Let's go to your Google Classroom and let's look at those questions. Let's looking at those questions. So first of all, let's look at question number 1. Let's look at the question number 1 I posted on 1635 relating to budgeting and variance analysis. Let's look at question number 1, please. So what do you think of question number 1? Can you, so are you able to see my screen, please?
Yeah.
Okay.
Yeah.
So I would like you select what's your answer for this question. What is your answer for this question? So it says a budget is a financial plan, okay, for an organization is that prepared in advance. So you make you preparing a budgeting in advance. Okay, you prepared in advance. Yeah.
Do you want us to say, or do you want us to submit it on our?
If you, do you wanna hand it in? Yeah, just
okay.
hand it in, so it is make more sense. Then I will mark it and.
Okay.
Any more? Any more answer? Victoria? In Young, what do you think of this question? It is true or false? Any more questions? Any more answers? What do you think, Victoria? Do we have a Victoria still? Yeah. In Young, what do you think of this question? Is it true or false? What do you think? A budget is a financial plan for an organization that is prepared in advance. So the correct answer is true, because we're preparing a budgeting for the future in order to controlling our expenses and in order to achieving our sales target figure, achieving our sales. Okay, so the answer is true. Okay. Okay, so let's move to question number 2, please. What do you think? It says, if actual costs are more than budgeted cost, the result is a favorable variances. If actual costs are more than a budgeted cost, then the result is favorable. Well done. Well done for both of you. Absolutely, you are right. This is cost. So always you try to actually is your actual should be less than budgeted. Should be less than budgeted. Thank you very much. Totally right. Yeah. If it is sale or income, then the answer is true. If it is sale, the answer is going to be true, but it is cost. For that reason, is obviously is false. It is false. Thank you. Okay, let's move to question number 3, please. And question number 3, you need to open. Excuse me. You need to open the Google Sheet. You need to open Google Sheet. So you need to open Google Sheet. Are you able to open Google Sheet?
Yes.
Great, great. I would like you to using a formula, because this is Excel sheet. So try to using a formula because this is Excel sheet. So try to use it if you can, if you are able to use it.
Sorry, I don't know how to do that.
Okay.
Sorry.
That's okay. Yeah. Yeah. Okay. So just one point, because obviously since excuse me, since only we're looking at the variances column should not be in negative.
should not be in negative. It is not necessary just budgeting minus actual. So always you should greater figure minus a smaller figure. So variance is only we're looking at the differences. It doesn't matter whether it is, yeah, yes, well done, well done. So if we're looking at the direct material, so we can't see, obviously the differences is 700. Well done. So whether it is adverse or favorable, adverse, it means our actual.
Sorry, how do we know, like, what amount is seen as, like, what's the parameters for the amount of whether it's favourable or not?
There is no limited or maximum figure, so there is no. So obviously in this situation, because direct material expenses, and we are trying to, obviously our budget is greater than actual, okay, because for direct,
so it's just if it's one way or the other.
Yeah,
okay.
yeah.
All right. Thanks.
So in this situation, yeah, well done.
Right. Okay.
Yeah, yeah.
Thank you.
Yeah, yeah. Well done. Well done. It is favorable for the labor because you spent less money than what they give it to you. Imagine you are a line manager, you have a number of staff and they give you 50,000, so only you spending 47,000, so it means you spend less money, so it is a favorable. Well done. Well done. And thank you very much. Yes, you did it absolutely in correct way. Thank you very much. So the variance is obviously just differences between the budget and actual. So since they are cost, so you're trying to your actual is be less than a budget. Your actual is going to be less than your budget, then it's going to be favorable. So for example, for the if we're thinking about the production overhead, we can see actual is greater than the budget. So they only give you 28,000, but you spend 31,000. So it is adverse because you you are not able to meeting a target. Thank you very much. And this is absolutely correct, 100%. Thank you very much. And this is question number 3. Let's move to question number 4. So let me marking Victoria is 3 and Nina also 3 mark. Okay, so let's move to question number 4. Okay, let's move to question number 4. Again, you need to open the sheet. Okay, so let's see. So let's see. So first of all, whether it is adverse or favorable, please tick it whether it is adverse or favorable.
Sorry, does the variance mean that they're all up by that amount?
This is actually, I think, that's a really good question.
We need the actual cost.
Yeah, and just give me one second. I think I made one small mistake in that question. Oh, okay, sorry. So they already it should be in here as a adverse. Just adverse. The second one is favorable. Sorry, I forgot to explain
Thank
it.
you.
Yeah, favorable, adverse, favorable, and favorable. Thank you very much. So now whether it is significant or not significant. Well done. Well done. Well done. Yeah. Thank you very much. Well done. It is 100% is correct. 100% is correct. Well done. So the first one and second one is not significant because it is not greater than the percentage, and the other is not greater than 4%. But usually you should like calculating the percentage. But thank you very much. Well done. Okay. Okay, so let's move to final question. Let's move to final question, question number 5. So what do you think about question number 5? So this is Excel sheet. So okay, so this is Excel sheet. So this is what we need to do. For example, we have a two requirement, A and B. So for the A, it says enter A or F in each cell in column E. Yeah. Yeah, so is any way just obviously the requirement for here is only it says only says is providing the formula. For example, for the first one it says it should be equal b2, okay, b2 minus, this is b2 minus c2 minus c2, okay. This is what they wanted, because if you remember I said the variances should be in just a positive figure. It doesn't matter whether it is favorable or adverse. Okay, so always if we're looking at B2 450,000 greater than C2, which is 446,000. Okay.
Sorry, how do you do the formula again?
Equal B2 minus C2. So B2 minus C2. So that's what it gives us for £1,000 difference. And for the second one, we says for the material we says equal. Okay, this time which one is greater? I think that figure is that figure. I think this figure it should be 14,000 14,500 14,000 no 114,500 and 114,600. So if we're looking at the material, we can see C3 is greater than B2. So in this situation, we say equal C3 minus B3. Okay. 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 So well done. Well done. Okay. Well done. That's what I am trying to explain it. Well done. And this one is adverse or favorable for the material? For the material should be adverse or favorable? Our actual is greater than budget. Should be adverse or favorable? So in terms of budgeting, what you did, you can do this way. Yeah, well done. Okay. And also if you're clicking on this functions, you can just click on sum and it gives you the total. And only for what do you think about the material? Material should be adverse or favorable? So what do you think of material? Okay, try to function and sum. Click on sum in cell B6. In cell B6, click on the sum. So if you click on sum, just like that, it says equal sum B2 to B5. This is one way, or otherwise you can say 1 by 1, but this is much easier way if you look at the formula. Okay, so then you can actually drag it over. You can drag it over. Can you see? Can you see this is when it is going to be a plus sign, and then drag it.
Do you need to know how to do Excel on the exam? Because
This
I have no idea.
I think this question, it asks you about Excel. It says, show me the way you do it on Excel. Because for your synaptic, we will study also Excel. So in that question, obviously it says use Excel. It says use formula. Okay, it says use formula. So we can say if we're using, you can say 1 by 1. It's like a B2 plus B3, B4, and plus B4. Or otherwise, the simplest way, just click on sum. And yeah, this is one way. Or the other way, obviously, you can just drag it over and it gives you the total for other one. If you click, can you see it is the orange? It says relating to that word. Okay. Okay, this is, it should not be in negative figure, it should be in positive. So which one is always greater minus the smallest one? So it means the budget is greater than the actual. So it should be budget minus, should be budget minus. Well done. And it is favorable or adverse. Well done, well done. And only material. What do you think of material? Material should be adverse also, I think. Yeah, the material should be adverse also. Well done. Thank you so much. That's, you did it. Well done. What do you think of this question? It's a bit.
The only thing that was difficult was Excel.
So
it's
yeah.
just difficult. I don't have a clue how to use it. So
Okay. Yeah.
Yeah.
Just trying to do the formulas for it.
Yeah.
In actual exam, if there is that kind of question using Excel, I wouldn't be able to do that.
Okay. Yeah, well, unfortunately, you may have a question. Unfortunately, you may have a question like that in the exam, asking about the Excel on. But I we will study Excel in synaptic last unit. So we will study Excel in synaptic. Okay, so don't worry about it for now.
That's great.
Yeah, so you will study, and thank you very much for tonight. This is all for tonight, and we did the question and we explained it, and we're going to finish earlier than expected, and I will uploading some advanced question for Thursday. So I will uploading some advanced question tomorrow, so it will be ready for Thursday. So it means by Thursday we completed element of costing. Okay, so okay.
Thank you.
And the exam for bookkeeping control is going to be on 8th of March. And exam for element of costing is going to be on 15th of March.
Are we definitely back in college then as well?
Well, is
certain or
well if based on the government, so we're preparing ourselves. So
okay.
So I am pretty sure. So even if it is not for the session for the exam, the college is going to be open. Even right now, we can booking the college is open for exam. So definitely the exam is going to be go ahead on 8 and 15. 8 is going to be bookkeeping control, and 15 of March is going to be element of costing. So all right, thank you so much for your participation and engagement, and see you on Thursday. Bye bye.
Thank you. Bye.
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 Bye.